Hi everyone! Wall Street ended last week on a negative note. However, the new one might be more favorable for stocks. On Monday, all three benchmark stock indices climbed, yet shares are rather volatile now due to uncertainty. The main reason for such sentiment was the comments of Fed policymakers. They were rather mixed and puzzled investors who were betting on a policy reversal in the near term. However, Fed officials stressed that key rates could remain at high levels for a longer period of time. Such remarks delivered a severe blow to stocks. Besides, policymakers did not clarify a new restrictive level for interest rates. It may be higher than expected if the labor market remains tight and inflation does not decrease. Nevertheless, all three stock indices are in the black this year. The NASDAQ gained more than 12% amid the recovery in high market cap stocks. More than half of companies included in the S&P revealed their earnings reports, with 69% of them exceeding forecasts. Despite their relatively good results, analysts expect a 3.1% drop in the net profit in the fourth quarter. In the next few days, Coca-Cola, Kisco and Applied Materials will publish their revenue results. The highlight of the week is the US CPI report. Fed officials are sure to take notice of it when making monetary policy decisions. Watch our video review till the end and find out more interesting details. Please leave your comment down below. Let's start. The Dow Jones rose by 200 points on Monday, while the S&P 500 and NASDAQ advanced by 0.5 and 0.7% ahead of important economic reports. The majority of traders are betting on another decrease in inflation. The January indicator is projected to fall to the lows of October 2021. A further slowdown in inflation may revive hopes for a policy change. It appears investors are prone to ignore the chorus of hawkish comments from Fed officials last week. They recalled an earlier speech by Jerome Powell at a press conference, who spoke about the disinflation process and the likelihood of a soft landing. GDP is growing, the labor market is strong, and inflation is declining. These are the main drivers for the stock market now. Excluding a pullback on Wall Street last week, its prospects are quite bright. Bullish momentum has become stronger, while bears have to retreat. Perhaps this is a long-anticipated trend reversal. There are also lots of signals confirming this. However, there are certain risks as well. Last week, the Dow Jones incurred smaller losses, dropping by only 0.17% compared to other indices. Besides, it was able to recoup its weekly losses on Monday. If we recall the movements on Wall Street since the start of the year, the results should actually cheer up investors. The Dow has gained more than 2% since January. However, speculators fear a more aggressive stance by the Fed. For example, the regulator is expected to raise rates to 6%. Some investors have already factored in such a scenario. Therefore, they are unwilling to take risks due to uncertainty. There are several reasons for an unfavorable scenario for the stock market. Inflation remains above the target level, and the regulator is ready to go to the extra mile to curb it. The unemployment rate is approaching a 70-year low. If inflation stops cooling, the Fed could raise rates more aggressively. The fact that the watchdog undertook a smaller rate hike at the February meeting means nothing. President of New York Fed John Williams said that the Fed would hike rates by 50 basis points if necessary. It may undermine the prevailing market optimism and the expectation of a full victory on inflation in the near term. Despite the cautious sentiment, bulls are not ready to retreat. They seem to pay zero attention to the Fed's remarks and the overall situation. Perhaps their approach is correct, or their excessive optimism will again lead to large losses. This is why the CPI report for January is likely to cause a sharp market reaction. Traders are sure to digest this data for the whole week. Naturally, if consumer prices jump, it will have a bombshell effect. However, such a scenario is extremely unlikely. The S&P is growing now. Last week it fell by more than 1%. Since the start of the year it has advanced by 6.5%. A weekly drop could be triggered by its overbought status as it was last August. Technical indicators signal a further rally. The S&P 500 has already risen above 4,100. It has been trading at these levels since early February. The resistance level is located at 4,325. From the historical point of view, we are now witnessing the start of a long-term upward movement. Since the Second World War, the index has grown by more than 5% in January after falling by 10% or more in the previous year. It proves once again how crucial January was. Last year was tough for stocks. However, there is a great chance that optimism will prevail in 2023. Everything will depend on inflation data. One should pay attention to the levels above 4,110. The S&P has been a step away from the upper border of the range located at 4,120 since September. If it breaks above this level and consolidates there, it is sure to climb higher. If it advances above 4,120, it may test the levels of 4,215 and 4,310. However, bears may regain their upper hand if the index dips below 3,930. The NASDAQ 100 declined the most last week, losing 2.4%. However, the index also managed to score bigger gains since the start of the year. The NASDAQ swelled 12%. Last week it asserted strength on the news from Microsoft. On Monday it resumed its winning streak, logging the largest increase of 1.5% during the session. A breakout above the December high of 12,166 shows that the index maintains a bullish bias, so traders are widely expecting a further upward movement. However, the level of the recent breakout of 12,166 was supposed to act as support, which bulls eventually failed to defend. The pivot levels are seen at 11,960 and 11,850. If the NASDAQ goes lower, it will signal a false breakout. The bulls may regain control this week if the macro stats are not disappointing. If the economic reports are positive, the index could reach the 12,740 level. It started a correction from this level in the fall of 2021 and 22. After a break above this level, it will face resistance levels of 13,175 and 13,600. If this scenario is correct, one should focus on whether the indices will be able to start a more steady uptrend. It will help assess how prolonged the rally could be. As for the tech stocks, Microsoft and Nvidia shares rose by more than 3% at the start of the new week, while Apple and Amazon gained more than 1%. These four tech giants facilitated the growth of the main stock indices more than any other companies during the earnings session. Analysts recommend paying attention to Microsoft shares. Morgan Stanley advises investors to consider purchases. The bank raised Microsoft's rating and target stock price to $307 apiece. The bank also assumed that the all hype is worth considering seriously. Citi believes that investors should add General Motors shares to their portfolios. Analysts at Citi called the company the best investment choice of 2023. That is all for now. Subscribe to our channel and keep close tabs on market developments. See you!